Otherwise, we'll have a problem when trying to sell, when trying to exit. So we need protection both for the majority and for the minority.
Welcome back, and today we're going to talk about drag along and tag along, which is a very crucial clause that you can have in your shareholders agreement. Indeed. So this is clauses that can give power to the majority owner and protection for the minority owner. So stick around, because at the end of this episode, we're going to give you an example how much money you can lose if you do not know about the drag along. So Kat, you're here today.
Hi.
Where do we start? Drag along and tag along.
Yeah. So you will basically, if you're a shareholder in a startup, you will have signed a shareholders agreement. And in that shareholders agreement, there will be rules about transferring of shares that, based on experience, the business world really has identified that we need to address this in the beginning of the corporation. Otherwise, we'll have a problem when trying to sell, when trying to exit. So we need protection both for the majority and for the minority.
Okay. So if you start with drag along, what is it?
So often a buyer of a company will want to buy everything, the whole company, 100% of the company. So imagine that you have some small shareholders. They might, if the big majority shareholders get the offer to sell, one or two minority shareholders might block the deal. And they might do it only because they're trying to sweeten their deal. I mean, almost a bit of blackmailing or green mailing, as we say it. So, in order to make sure that this cannot happen, the drag along is a clause that says that if a majority, typically 75%, but you can have higher or lower, if 75% want to sell to an external buyer, then the minority can be forced. We can drag them along, so they be forced to sell at the same price and at the same conditions as the majority.
Even if they don't want to?
Yeah, even if they refuse and say no. You can say, we have a drag along, so you have to sell at the same price, no matter what price you invested.
Okay. Is it common that people don't know about the drag along and they are a minority shareholder and then just...
Absolutely. Yeah, and we'll get back here and show you exactly so you understand how crucial it is that when you enter into the shareholders agreement, that you understand the dynamics in your specific case. And like I said, we'll get back to that.
We'll get back. And that was the drag along.
Yeah. So first, we will just show the flip side, and that's the tag along. And the tag along is the protection for the minority. Drag along protecting the majority, tag along protecting the minority.
Okay.
And the reason is that if a majority gets an offer to sell their shares, there's also a risk that they sell it to, for example, a strategic buyer who won't be interested in buying all shares, because it's more pricey to buy 100% of the shares than 75%. And they might not care the least if they have some minority shareholders left on the cap table, because they will not make any big changes. They will not need to make general meetings with new resolutions. So it won't really be a problem for them. Then you, as a minority, might end up in a situation where you have shares in the company that you can't really sell, because the exit plan has already been executed, but you weren't allowed to come along. So the tag along says that if a majority, again, the hurdle rate can differ, but say 75%, want to sell their shares, you have a right to demand that you get to sell at the same price, equal terms as the majority.
Wow, that sounds like a good protection.
Very, very good. And it will be the majority's responsibility to make sure that you get to sell with them. So as the majority, you need to turn to your buyer and say, we have a tag along. Do you want to buy 100%? And if he says yes, no problem. Everybody gets to go along, tag along, fine. But what if
he says no?
He says, I only wanted to buy your 75%. Then it will be the case that everybody gets to sell pro rata and their proportion of their ownership in the company. Which means that if only 75% gets sold, I, as a majority shareholder who wanted to sell all of my 75%, only get to sell 75%, and I get to remain a shareholder for 25%. And you, the minority, you will also get to sell 75% of your shares and keep 25%. So it's completely equal. Everybody will be stuck in the company in that case.
Okay. So that's why the tag along is really good.
Fantastic.
Fantastic. That sounds amazing, because is it common that people don't think about having the tag along?
I will say that often it's in the contract, but people do not review it. Because in specific cases, you might want to lower the tag along right to 50%. And another thing that's very important protection for you as a minority, you will want to regulate how the price is paid, the remuneration for the shares. Because you as a minority want to say that it should be cash, or at least be paid in shares traded at a publicly traded company. Because that's equal to the liquidity, really. And often you can get more value if you accept shares instead of only cash. But you will not want to get paid in shares in a private company, because then you might still end up in a locked-in situation where you cannot exit, you have no liquidity. So you should regulate what type of payment is okay.
Okay, wow. I learned a lot from this.
Yeah.
So do we have an example?
We do have an example, and I have one thing to add before that. Another thing that's important, depending on your position, is the thing, because in the shareholders agreement, there will also be a right to first refusal. And that's a right that if I want to sell to a third party, you as a shareholder can say, you know what, I want to buy instead. And you need to, or at least you really should address, if that right to first refusal should also apply in the drag-along situation. Because if you're a medium-sized shareholder, you might want to have that trigger and say, I'll take over the company. I have the finances, I have the power needed to do that. But if you're the majority looking to sell to and negotiate with a third party, you will dislike that the right to first refusal applies to a drag-along, because a buyer might not feel that it's worth going through the term sheet, the due diligence, the negotiation process, if there's a risk that somebody else comes in and swoops the deal away. So depending on your situation, address whether you want the right to first refusal to apply in the drag-along situation.
Okay, good to know.
Good to know.
Good to know. So we're moving on to the example.
Yeah.
So to know about the drag along, so you don't lose money.
Yeah, we'll show you exactly how it works. So
perfect.
Yeah. So imagine that we have a company. The majority, I'm the majority. So I hold I'm the VC. I'm a VC, and I invest 20 million at the post-money valuation of 200 million. So I get 10%. The founders control 65% of the company. So together we control 75%.
Yep.
And as typical when you get VC investment is that the company gets great PR. Everybody celebrates and everything goes brilliant. The company grows and grows and grows. And then you, Ida, you, a savvy business angel.
Yes.
You get to offer a couple of years later to buy shares at the valuation of 400 million. And you're happy to take it. You invest $1 million and you get 0.25% of the company. But then, also typical in the startup world, nothing happens. The company falls flat and starts declining little by little for 3 years. And then a strategic buyer comes and offers to buy the company for 100 million, which is the fair market value at that point in time. Well, the VC who got preference shares jump at their chance because they have that downside protection. And the founders who has invested exactly zero money, I mean blood, sweat and tears, but no money, they jump at the chance. And given that they together control 75%, they trigger the drag along. So they force you, Ida, to sell together with the other minority shareholders. So let's look at the result. The result will be that the VC with the preference shares get their investment back first. They get 20 million. The founders holding 65% will get 65% of the remaining 80 million. So they get 52 million. They're actually really happy.
I understand that.
Yeah. And left for you minority shareholders who together had 25% will be 8 million. And you, Ida, you will then get 0.25% of that 80 million that was left after the preference shares got their cake. That means that you get $222,222 US.
Sounds like a big loss.
Yes. So the result is that you, Ida, you were forced to sell. You did not want to sell. You believe the company can still grow and catch up to the value of 400 and grow beyond that. But you were forced to sell through the drag along. You invested 1 million. You got $222,222 US. So you made a loss of $787,778 US.
Whoa. So what should I do in that situation?
You can do nothing.
Oh, no.
You can just take the loss.
So, okay, if we put it back in time, what could I do instead of just agreeing to that in the beginning?
What's good is to understand that in particular where you have the drag along, is that if you have investors who have invested in different phases and you have somebody with preference shares, and you have founders who will be happy with millions, I mean in any size, way or form, then you will have extremely different trigger points for when it's good to sell. So if you enter in on a high note, you might be forced to sell on a low note for you, but that might be a high note for somebody else. So understand how dangerous and how powerful the drag along can be. And when you enter into the company, review the stakeholder mapping, the stakeholder world, to understand who invested at what phase and where you're at in the priority, in the pecking order. Because if you're really low in the pecking order and you're entering on a high valuation, perhaps it's not the right time to invest.
Wow.
Wow.
So that's why it's very important to read it through from the beginning and understand where you are, as you said.
Yeah.
To not lose money, because it was a lot.
It was a lot.
But I understand it might be quite common that people are ending up like this.
Very common. It really is. In particular now when we really see startups failing, times are tough, people just want to recuperate. Many VCs are happy to just get their preference shares so they can move on to another venture and find somewhere else where they can get a higher return on their investment.
Well, we talked about preference share in another episode, which I can just link below. Very interesting. Thank you so much.
Thank you.
So, I mean, if you're listening to this is so good knowledge to have. You have another thing in your toolkit now to master the business law.
Indeed.
So hang on, because you get this knowledge at zero cost, and we're going to keep doing this, and we want you to be around. So please drop questions below. It feels so good to do this because I know it will be valuable for you.
Thank you.
Thank you, and I'll see you around.
Thank you.